the tape is flashing euphoria, but the real story is that the plumbing just tightened. And that's why you're early, not late. Everybody S staring at the headline move in gold and silver like it was a mood swing. The market wants you to believe it's just another risk-on, risk-off tantrum. But underneath the candles, something more important is happening. The rules of participation are changing in real time, and that's where the pressure builds. And if you catch this now, before the crowd relabels it after the fact, you'll know exactly what to watch next week, what level matters this month, and what breaks the whole setup if it fails. Here's the context right now, with no romance. Gold is still camped in a zone that used to be a decade's target. Silver is whipping around like a leveraged instrument pretending to be a metal. That contrast is not a warning sign. It is the signature of a regime where gold is being treated like a monetary asset and silver is being treated like a stress test for leverage. And that difference is exactly how people get shaken out at the worst time. Because the market doesn't need to disprove the thesis. It just needs to make you emotional. It needs to make you trade your own conviction against you. And that's where the real game starts. The reason you're early is not because you caught a perfect bottom. The reason you were early is because the market is still arguing with itself about what this move even is. When the story is settled, the easy trade is already gone. Right now, the story is unsettled. You can feel it in the language. Too far, too fast. Overbought, blow off, speculation. It'll cool down. Those phrases are not analysis. They're psychological anchors designed to make you expect mean reversion as the default. But in a regime shift, mean reversion is the trap. The market doesn't revert to the mean, it reprices the mean. And that brings us to the first conflict. People love to talk about suppression like it's a cartoon villain. That's not what matters. Most reliable downward pressure in a fast metals tape is boring and mechanical. Risk management, margin, liquidity rules, position limits. The internal do not blow up switch inside every leveraged book. That pressure doesn't care if you're right. It cares if you can pay. It cares if you can carry the position through volatility. And when volatility spikes, the market tightens the screws. That's not a conspiracy. That's structure. And structure creates forced behavior. When exchanges hike margin requirements into volatility, you don't just get a calmer market. You get forced deleveraging. You get people who were comfortably long suddenly needing cash. You get desks trimming risk not because the thesis changed, but because the risk budget changed. And silver, more than almost anything, is where that shows up like a punch to the face. Silver is smaller, thinner, more reflexive, more sensitive to leverage. So when the rules shift, silver doesn't glide. Silver snaps. That's why silver can feel like it's betraying you in the middle of a bullish regime. And that betrayal is the point, because it flushes weak hands and resets positioning. But that's not the part that matters. The part that matters is what happens after the flush, when the market tries to trade back to safety and realizes the physical bid didn't leave. Now layer in the calendar, because this is where people get blind. Early January is not just another week. Early January is when liquidity is still thin, desks are still normalizing risk, and positioning is being rebuilt with fresh budgets. It when the first real price discovery of the year happens, often violently, because the market is transitioning from holiday-thinned flow to institutional re-engagement. That transition creates air pockets. It creates overreactions. It creates moves that look like fake-outs right before they become breakouts. And then you add one more layer, options. Options don't just sit there. Options are a living, breathing set of obligations. They create hedging flows. They create gamma effects. They pull price towards certain strikes when liquidity is thin. They can either dampen volatility or amplify it, depending on where positioning sits. And as you approach monthly expiration, the market's behavior changes even if the fundamental narrative doesn't. That's why you can have a week where the macro thesis looks perfect, and yet price behaves like it's trying to embarrass anyone who bought the story. Because it is. Because if one level breaks, the math changes. Here's the hidden detail that reframes the whole thing. The dip is not the verdict. The dip is the test. In a high volatility metals regime, pullbacks are not the market saying, this was wrong. Pullbacks are the market checking who's forced out, who can't meet margin, who is late and levered, who has weak risk controls. If the pullback happens and the physical market stays bid, the pullback isn't bearish, it's constructive, it's a pressure valve. It's how the market reloads without blowing itself apart. And that's where the real pressure starts. This is why you have to stop watching the price like it's a truth machine. Price is a negotiation between paper and physical, between macro and supply chain, between leverage and inventory. Paper gold can trade like a macro factor. Physical gold trades like a supply chain. When those disagree, the paper can bully the tape for a while. But the physical side has one advantage: the paper side can't fake forever. Delivery realities, fabrication demand, refining bottlenecks, import flows, premiums, the symptoms on the ground. When physical buyers step in on dips, especially in places that actually consume metal, price discovery eventually gets dragged back toward that reality. It doesn't always happen on your schedule, but it happens. So let's make it tangible. When you hear about physical premiums in key regions rising even as the headline price retreats from a high, that's not noise. That's information. That is the physical market saying, we don't care that the paper tape is wobbling. We still need metal. And when the physical side is still bidding, it creates a floor that paper selling has to fight. It doesn't eliminate drawdowns. It changes what drawdowns mean, but that's not the part that matters. The part that matters is what that physical bid forces the paper market to do next, because paper markets run on balance sheets. If you're a dealer, you're not holding infinite risk. You're managing inventory, hedging exposure, optimizing funding. If the physical market tightens and premiums rise, someone is paying up to get metal now, not later. That now versus later stress eventually bleeds into spreads, into lease rates, into the subtle signals that scream louder than headlines. You don't need to believe in magic, you just need to watch where the pain shows up. Now zoom out to the dollar, because this is the macro layer everyone keeps trying to oversimplify. The dollar doesn't need to collapse for metals to do well. The dollar just needs to stop being a wrecking ball. And if you've been watching the last year's behavior, you've seen a regime where the dollar can weaken meaningfully, and yet the world doesn't instantly become calm. That matters. Because a weaker dollar regime changes the calculus for reserves, for hedging, for global purchasing power, for capital flows. It also changes how markets price future policy. If the market is leaning toward easier policy, if cuts are being priced, even partially, then the discount rate lens changes. The carry cost narrative shifts. The opportunity cost argument gets less sharp. And gold, which thrives when real rates are less punitive and currency confidence is more conditional, stops being treated like a relic and starts being treated like a tool. That's not ideology. That's portfolio construction. It's math. This move isn't emotion. It's math. And when math shifts, people who wait for a neat story get left behind. Now, silver. Silver is where people lose religion. Silver is where they turn bullish at the top and cynical at the bottom. Silver is not small gold. Silver is a volatility machine with an industrial floor. It has monetary narrative attached to it, but it also has real-world demand tied to manufacturing, electronics, energy tech, and a chain of supply constraints that doesn't flex overnight. And because silver is smaller and more levered in paper form, it is more sensitive to positioning shifts, margin changes, and forced liquidations. Silver will not move politely. It will move like it's trying to punish anyone who's overconfident. That's why it can rip to a new high and then rip your face off on the retrace, even inside the same bullish window. This is where market structure becomes your compass. Because when the crowd is emotional, structure tells you what participants are forced to do. And forced behavior is tradable information. If margin requirements tighten, leverage longs reduce. If volatility spikes, risk parity and vol target funds de-risk. If liquidity thins, stops get hunted. If options dealers are short gamma in a zone, they are forced to hedge in the direction of the move, which can amplify both rallies and sell-offs. None of this requires secret meetings. It requires incentives. It requires survival. And here is the part the mainstream misses almost every time. The same mechanism that can smash price lower in a day can also ignite the next leg higher when the pressure flips. That's the reflexivity. That's why you don't anchor on a single candle and declare victory or defeat. You anchor on what the system is doing. You watch whether dips are being bought in the physical market. You watch whether the dollar bounce actually gains traction or fizzles. You watch whether the market can hold prior breakout zones on retests, because if it can, the math changes. Let's talk positioning, because this is where the why becomes mechanical. In futures markets, someone is always on the other side. When managed money gets heavily net long, that doesn't mean the move is over. It means the move is crowded in one lane. And when a trade is crowded, it becomes sensitive to shocks. A margin hike, a sudden dollar spike, a risk-off day, a liquidity air pocket. Any of those can trigger a cascade of trimming. But the existence of that sensitivity doesn't disprove the underlying regime. It means the path will be violent. It means you should expect shakeouts, not smooth stairsteps. And on the other side of those longs, you often have commercial hedgers and swap dealers, the parts of the ecosystem that manage risk differently. They are not evil. They are structured differently. They hedge production. They intermediate flow. They balance books. Their presence changes how squeezes happen and how relief rallies form. And if you want to understand why silver can feel like it's being yanked by invisible strings, it's because the strings are real. They're called hedges. They're called margins. They're called risk limits. And when those tighten, the whole system behaves like a single organism trying to reduce exposure at once. Now we stack proof, because you don't build trust with one argument. You build trust with 5. Here's your stack, the way a desk would look at it. 1, price context. Gold holding an elevated zone after a historic run is itself a signal. A true blow-off typically doesn't hold high quietly. It collapses and stays broken. Holding high is what repricing looks like. 2. Physical signals. When premiums in big consuming regions don't collapse on dips, that's real demand behavior, not Twitter narrative. 3. Market rules. Margin hikes and volatility management are direct proof of stress. The system doesn't tighten unless the system feels risk. 4. Positioning. When longs are crowded, you should expect drawdowns that are flow-driven, not thesis-driven. 5. Macro regime. A dollar that's not a relentless crusher, combined with policy expectations that aren't tightening forever, creates a persistent tailwind for hard assets. Each of those points to forced behavior. That's the key. Not opinions. Forced behavior. Now we shift the shape, because you need a quick calculation without pretending precision. Think about what it means if gold is holding a high zone while the dollar is not screaming higher. It means global buyers are not being priced out. It means the currency headwind isn't doing the heavy lifting of suppressing demand. And when you add the idea of ongoing reserve diversification behavior in the background, central banks and sovereign actors thinking in decades, not days, you get a bid that doesn't panic sell because the daily candle was red. That bid doesn't eliminate volatility. It changes the outcome of volatility. It means sell-offs find buyers, and that's where the real pressure starts. But let's be honest about the counterpoints, because trust dies when you pretend risk doesn't exist. Metals can whip around violently even if the thesis is correct. You can be right on the regime and wrong on the week. You can be right on direction and wrong on timing. A sharp dollar bounce can slam metals temporarily. A surprise policy message can spike yields. A liquidation wave can break technical levels and trigger more selling. And silver especially can behave like a leveraged proxy for risk on risk off for stretches. That's real. That's why you need a framework that separates trend signal from noise. Trend signal is the market holding key zones after stress, keeping higher lows, maintaining constructive behavior on retests, and seeing physical demand show up when paper sells. Noise is the intraday spike, the stop-run wick, the day where liquidity evaporates and the chart looks like a heart monitor. Noise is the market trying to make you feel stupid. Trend signal is the market forcing you to be patient. And that's why you don't build a plan around, I feel bullish. You build a plan around, what would invalidate this? And that brings us to what happens next, because this is where you get paid. Not in money promises, but in clarity. Over the next week or two, you should expect one of 2 clean patterns to dominate. One pattern is the controlled pullback and retest. That looks like gold and silver backing off, scaring people, chopping, and then defending prior breakout zones. It feels boring at first and then suddenly feels obvious after it works. In that pattern, you watch whether the market can absorb selling without cascading. You watch whether the dollar bounce, if it appears, stalls quickly. You watch whether physical premiums remain firm or even rise into dips. You watch whether minor equities stop bleeding relative to the metal and start stabilizing. Because that's the part that matters. The second pattern is the continuation squeeze. That looks like the market refusing to give you a clean entry. It looks like a pop that doesn't retrace the way you want. It looks like thin liquidity producing gap risk, especially around key calendar points, where dealers are forced to hedge in a way that feeds the move. In that pattern, you watch for violent upside days followed by shallow pullbacks. You watch for silver to lead temporarily, because silver often leads in the reflexive phase. And you watch for the mood shift. The same people who called it a blow-off suddenly start calling it a new paradigm. That's usually when risk increases, but that's not the part that matters. The part that matters is knowing which scenario you re-in before your emotions pick one for you. So what levels matter? Not because we're doing fortune telling, but because levels tell you where forced behavior triggers. You're looking for the market to respect prior breakout areas. You're looking for the market to reject lower prices quickly, not necessarily to rally every day. You're looking for reactions that are fast and decisive at zones where liquidity should exist. And you're looking at the dollar's behavior as the macro pivot. If the dollar starts trending higher with conviction, metals will feel heavier. If the dollar remains soft or choppy and fails to sustain strength, metals have room to stay bid. If the market breaks below key support zones and cannot reclaim them on a retest, that is how the thesis weakens. Not because you feel it, but because the market is telling you the bid isn't there. Now we pivot into miners, because this is where the "you are early" line stops being motivational and becomes structural. The market always trusts the metal before it trusts the miners. The metal is liquid, immediate, macro-friendly. Miners are messy. Operational risk, political risk, financing risk, dilution risk, all the things that make investors hesitate. So, in the early phase of a metals regime shift, you often get a huge move in the metal and a lagging, frustrating response in the equities. That lag is not proof the metal is wrong. It's proof the equity market is demanding confirmation. And when confirmation arrives, when the metal stays high long enough for business models to reprice, the equities can re-rate in a way that looks like it came out of nowhere. It didn't. It came out of patience. This is where first mining gold fits as a clean case study because it embodies a concept most people understand emotionally but not mechanically: optionality. Optionality is when the value of an asset changes non-linearly as the underlying input changes. For a developer stage gold company, that input is the gold price, the cost of capital, and the market's willingness to fund projects. When gold reprices higher and stays there, the economics of projects can change dramatically. Net present value can expand, internal rates of return can improve, the universe of potential partners grows, the terms of capital can become less punitive. The market doesn't instantly price that in, especially if volatility is high. But when it starts to, it can move fast. Think about what a project looks like in a lower gold price world versus a higher gold price world. In a lower price world, everything is tight. Margins are skinny, funding is expensive, any hiccup is fatal. In a higher price world, the same deposit can become strategically interesting. It can become financeable. It can attract attention that wasn't there before. And the market, which loves to price the future in a wave, can go from ignoring it to chasing it. That's where the asymmetry lives. But that's not the part that matters. The part that matters is how you judge whether a miner is in the survive and re-rate category or the dilute and disappoint category. So you look for oxygen, runway, balance sheet flexibility, evidence that near-term financing risk is reduced. When a company demonstrates it can raise money without destroying shareholders, or when it receives proceeds that meaningfully extend runway, that changes perception. It changes what investors fear most. And in a tape where volatility is used as a weapon, removing the fear of immediate dilution is not a small thing. It can be the difference between a chart that dies and a chart that wakes up. Now, step back, because this is where the viewer psychology shield becomes non-negotiable. If you stay in this space long enough, you'll see the same manipulation pattern over and over, not illegal manipulation, but emotional manipulation. Volatility is the weapon. The market will show you a massive green move and trigger greed. Then it will snap back and trigger fear. Then it will grind and trigger boredom. Boredom is underrated as a killer. Boredom makes people abandon a thesis right before it plays out. Fear makes people sell bottoms. Greed makes people buy tops. And the market doesn't care which emotion it uses. It just needs you to act at the wrong time. So here's the shield. Decide ahead of time what you're actually betting on. Are you betting on a long-term macro repricing? Then daily noise is mostly irrelevant. Are you betting on a short-term squeeze? Then you must respect the fact that squeeze trades can reverse violently. If you don't know what horizon you're operating on, the market will choose one for you, usually the one that hurts. Define your invalidation, not a vibe, a condition. If the dollar trends higher and metals lose key support zones and fail to reclaim them, that weakens the setup. If physical premiums collapse and the market can't rally on good news, that's information. If miners keep underperforming while metal holds, that can be normal early, but if it persists through stability, it can be a warning. Those are conditions. You can track them, you can stay rational. And you have to internalize this one line. Price can whip around violently, even if the thesis is correct. This is not a feel-good disclaimer. This is a survival statement, because it frees you from the trap of thinking every red day means you were wrong. Sometimes red days are the mechanism working. Forced selling creates discounts. Discounts create reloading. Reloading creates the next leg, but only if the underlying bid remains. And that's why you watch the right signals, not the loudest ones. Now let's bring it back to the hidden mechanism the mainstream missed, because I promised you a payoff. The hidden mechanism is this. The market is being forced to reconcile paper leverage with physical constraint at the same time that the currency regime is loosening. That is a rare combination. When paper is heavily positioned and volatility forces deleveraging, you get sharp dips that look like reversal. When physical demand remains present on those dips, you get a floor that paper can't erase without a broader macro shock. When the dollar is not an unchallenged king, the bid under hard assets is structurally stronger. And when options and calendar flows amplify price around key dates, you get a tape that looks like chaos, but is actually the market doing math in public. So what do you watch next week? You watch whether the market sells into thin liquidity and then fails to follow through. You watch whether the dollar bounce, if it arrives, becomes a trend or just a reflex. You watch whether gold holds its prior breakout neighborhood on retests. You watch whether silver's drawdowns are being met by quick buying or slow bleeding. You watch whether miners, especially developers, stop acting like they're doomed and start acting like they can breathe. You watch whether the paper versus physical divergence widens or narrows. And you watch the way volatility is used. Because volatility is how the market taxes impatience. If the controlled pullback and retest pattern plays out, don't confuse it with weakness. That pattern is often the market building a base at a higher altitude. If the continuation squeeze pattern plays out, don't confuse it with inevitability. Squeezes can reverse violently. In both patterns, discipline beats excitement, because the market is not paying you for being emotional. It pays you for being positioned correctly when other people are forced to act. And now, a final point on trust, because you're not here to be entertained, you're here to build a process. The process is not always bullish metals. The process is understand the mechanism, respect the risks, and watch the tells. The tell is not a commentator's confidence. The tell is behavior under stress. Does the market break and stay broken? Or does it snap back and defend? Does physical demand disappear when price dips, or does it show up? Does the dollar trend higher with momentum, or does it stall? Do miners begin to catch up as the metal holds, or do they continue to signal financing fear? Those are tells, they're not opinions. If you want to participate in this space without getting emotionally harvested, you build a checklist and you follow it when your brain is loud. You remind yourself that volatility is designed to make you abandon the trade at the worst time. You remind yourself that being early doesn't feel like being right. Being early feels uncomfortable. It feels like everyone is telling you it is too late right before it is too obvious. That's the price of entry. And the payoff is not guaranteed returns. The payoff is clarity. The payoff is knowing what matters. So here's the community signal, and it's simple. If you are the kind of investor who wants mechanisms over memes, who wants structure over slogans, who wants a plan instead of a vibe, then stay in this corner. Because the next move in gold, silver, and the miners won't reward the loudest people. It will reward the calm ones, the ones who can watch a violent tape and still track what is actually happening underneath it. Drop the one metric you're watching the closest. Dollar behavior, physical premiums, positioning, margin changes, minor lag, or those key retest zones, because that's how you build a smarter crowd. And next week, when the market tries to turn this into a simple story, you'll already know where the real pressure starts.